What if I told you that one quiet decision made by Warren Buffett years ago could be setting the stage for one of the biggest investment opportunities we've seen in decades, and most people have no idea it's happening right now? What if a simple metal, often ignored and underestimated, is sitting at the center of a massive shift in the global economy, while powerful institutions work behind the scenes to control the narrative? Something unusual is unfolding in the silver market, and the signals are getting stronger by the day, even though mainstream voices are doing everything they can to downplay it. Internal banking behavior, long-term supply shortages, and explosive industrial demand are lining up in a way we haven't seen before, and history shows this kind of setup doesn't come around often. Many investors believe they already missed the move, but when you look deeper, it becomes clear that the real story may just be getting started. Stay with me, because what you're about to hear isn't hype. It's a clear breakdown of facts, trends, and patterns that most people are never shown. Welcome back to Alex Carter Reports, the channel where we look past headlines and dig into the moves that wealthy investors quietly make while everyone else is distracted. If you're new here, this is where we break down big money strategies in simple terms, without the confusing language or fear-based talking points pushed by the media. Before we go further, take a second to support this video by hitting the like button, because it helps this information reach people who are searching for real answers. And if you haven't subscribed yet, now is the time, because this deep dive into silver is only going to get more intense in the coming weeks. To understand what's happening today, we need to go back to a moment that most investors have completely forgotten, even though it changed everything. Back in 1997, silver was trading at less than $5 an ounce, and almost nobody cared about it. Stocks were booming, tech was exploding, and silver was seen as boring, outdated, and useless by most of Wall Street. But while the crowd ignored it, Warren Buffett was quietly paying attention. Through Berkshire Hathaway, Buffett made a move that shocked the financial world once it became public. He bought approximately 129.7 million ounces of physical silver, not paper contracts, not promises, but real metal. That amount came out to nearly 4,000 tons of silver, which represented around 20% of the world's above-ground supply at the time. This wasn't a small gamble or a quick trade. It was a massive conviction play based on deep research and long-term thinking. Buffett invested roughly $680 million when almost everyone else thought silver was dead money. The media laughed, analysts criticized the move, and many claimed he had finally made a serious mistake. But Buffett wasn't guessing. He was responding to a supply and demand imbalance that most people couldn't see. Over the years that followed, silver prices steadily climbed, and Berkshire Hathaway exited the position at much higher levels. By the time the dust settled, Buffett had made well over $500 million in profit, with some estimates placing the gains even higher. That trade wasn't luck, it was patience, combined with an understanding of how markets behave when supply gets tight. Now here's where things start to feel familiar, in a very uncomfortable way. Fast forward to 2026, and we are seeing many of the same warning signs that existed before Buffett made his move. Only this time, the conditions appear even more extreme and the stakes are much higher. Silver has once again been pushed to the background in public conversation, even as demand quietly explodes. At the same time, one of the largest financial institutions in the world is behaving in a way that should make every investor stop and think. JP Morgan, a bank with a long and controversial history in the silver market, is sending mixed signals that don't add up. Publicly, their analysts are warning that silver prices could fall sharply and return to much lower levels. Privately, however, the bank has been accumulating enormous amounts of physical silver. Estimates suggest JP Morgan now controls roughly 750 million ounces of physical silver, an amount that is impossible to ignore. Think about that for a moment, because actions always speak louder than words in financial markets. On one hand, they tell the public that silver is risky and overvalued. On the other hand, they are stockpiling the metal at a historic scale behind closed doors. The same bank was fined $920 million for manipulating the silver market over an 8-year period. That fine wasn't for a minor mistake. It was for deliberate price manipulation through fake orders designed to push prices down. During that time, silver prices were kept artificially low, while large players accumulated physical metal. So when JP Morgan warns about falling prices today, investors should ask whether history is repeating itself. This brings us to what silver just experienced recently, which caught the attention of even casual observers. In 2025 alone, silver surged from around $29 per ounce to over $72 per ounce. That move represented a gain of roughly 147% in a single year. In early 2026, intraday prices even spiked close to $100 per ounce before pulling back sharply. Many people wrote this off as a speculative bubble, but that explanation ignores the deeper forces at work. This was not a random spike driven by social media hype or short-term trading. It was the result of years of pressure building beneath the surface of the market. At the heart of the issue is something most investors don't fully understand, which is a long-term supply deficit. For 5 consecutive years, the world has consumed more silver than it has produced. In 2025 alone, the global shortfall was estimated at around 230 million ounces. That means demand exceeded supply by a massive margin, and that gap continues to widen. Silver mine production actually peaked back in 2016 at around 900 million ounces. By 2025, production had fallen to approximately 835 million ounces. Even worse, most silver is mined as a byproduct of other metals like copper, zinc, and gold. This means you can't simply open new silver mines to fix the shortage. Supply is rigid, slow to change, and highly limited, no matter how high prices go. As we move forward, this imbalance becomes impossible to ignore, especially when we look at where demand is coming from next. To truly understand why silver demand is exploding, you need to stop thinking of it as just a shiny metal people store in safes or turn into jewelry. Silver has quietly become one of the most important industrial materials in the modern world, and most people have no idea how deeply it is woven into everyday technology. Unlike gold, which is mainly used as a store of value, silver is consumed in the production process and often cannot be recycled economically. Once silver is used in electronics, solar panels, or industrial components, much of it is gone forever. This makes silver fundamentally different from many other commodities because supply keeps shrinking while demand keeps growing. One of the biggest drivers of this demand is the global push toward renewable energy, especially solar power. Around 15% of all silver consumed worldwide now goes directly into solar photovoltaic panels. Every solar panel relies on silver paste to conduct electricity efficiently, and there is currently no affordable replacement that works as well. Governments around the world are racing to expand solar capacity as part of climate and energy security goals. Industry projections suggest global solar capacity could reach approximately 2,500 gigawatts by 2030. If that happens, solar energy alone could consume more than 200 million ounces of silver every single year. That number is staggering when you remember that the entire market is already facing a supply deficit. And solar is only one piece of the puzzle. Electric vehicles are another massive source of silver demand that continues to grow at an accelerating pace. Silver is used in electric vehicle charging systems, battery management units, power electronics, and safety components. As EV adoption increases worldwide, the amount of silver required per vehicle becomes a critical factor. Even small increases in per unit silver usage can translate into millions of ounces of new demand. Then there's the rollout of 5G networks, which require far more silver than previous generations of communication infrastructure. 5G base stations, antennas, and network hardware all rely on silver for reliable conductivity and heat management. As countries race to expand digital infrastructure, silver demand rises quietly in the background. Artificial intelligence adds another powerful layer to this story. AI data centers require massive amounts of high-performance computing hardware, all of which depends on silver-based components. Servers, circuit boards, memory systems, and power supplies all use silver in small amounts that add up quickly at scale. This is not a short-term technology trend that fades away in a few years. This is a structural transformation in how the global economy operates. Silver sits at the center of this transformation, even though it rarely makes headlines. At the same time, industrial demand is surging. Governments and central institutions are beginning to treat silver differently. Central banks and sovereign wealth funds have quietly increased their interest in silver as a strategic resource. China, in particular, has emerged as a major force in the silver market. Reports suggest Chinese buyers have played a significant role in recent price movements. Many experts believe China is stockpiling silver not just for manufacturing, but for long-term national security. When a country of that size starts treating a metal as strategically important, it sends a powerful signal. This behavior suggests silver is no longer viewed as optional or replaceable. It is becoming essential to future economic stability and technological independence. At the same time, private investors around the world are starting to realize how undervalued silver may still be. One of the most common ways to measure this is through the gold to silver ratio. Historically, this ratio has averaged around 15 ounces of silver to 1 ounce of gold. Even after silver's recent rally, the ratio remains far above historical norms. This imbalance suggests that silver still has significant room to rise relative to gold. Many long-term investors see this as a clear signal that silver is lagging, not leading. Now let's bring this back to Warren Buffett's mindset, because his approach offers important lessons. Buffett has always focused on assets with real-world utility and strong fundamentals. He looks for situations where the market is mispricing something due to fear, neglect, or misunderstanding. When he bought silver in 1997, he wasn't chasing price momentum. He was responding to a clear supply-demand imbalance that others ignored. Today, that imbalance is even more pronounced. The supply deficit is larger, industrial demand is stronger, and global uncertainty is higher. Geopolitical tensions, trade disputes, and currency concerns are all pushing investors towards tangible assets. Silver benefits from both industrial use and safe haven demand, which is a rare combination. While Berkshire Hathaway's public filings do not show a massive silver position today, Buffett's principles still apply. His philosophy points toward assets that are essential, scarce, and undervalued. Silver checks all three boxes in the current environment. Now, let's address the issue that makes many investors nervous, which is volatility. Silver prices have been extremely volatile, especially in late January 2026. Prices dropped from near $100 to the low 60s in just days. This sudden move scared many people out of the market. Some blamed rising margin requirements in futures markets. Others pointed to profit-taking after a historic rally. JP Morgan's public warnings about a crash also weighed heavily on sentiment. But volatility does not mean the underlying story is broken. In fact, volatility is a normal feature of every major bull market. Sharp corrections are often designed to shake out weak hands, and they create opportunities for patient investors who understand the bigger picture. If you look at gold's bull run from 2000 to 2011, it experienced multiple deep pullbacks. Despite those corrections, gold rose from around $250 to over now $900. Silver appears to be following a similar path, just with sharper swings. The key difference between success and failure in volatile markets is perspective. Short-term price moves feel emotional, but long-term trends are driven by fundamentals. And those fundamentals remain firmly in silver's favor. To understand where silver prices could go next, you have to understand how distorted the silver market has become behind the scenes. Most people think silver prices are set by supply and demand for physical metal, but in reality, prices are largely driven by paper contracts. The futures market allows traders to buy and sell silver that doesn't actually exist in physical form. This creates a situation where claims on silver far exceed the amount of real metal available for delivery. One of the clearest examples of this imbalance is the March 2026 silver futures contract. That single contract represents roughly 528 million ounces of paper silver exposure. At the same time, there are only about 113 million ounces of physical silver available in exchange warehouses for delivery. This means there are nearly 5 claims on silver for every ounce that actually exists in the system. As long as most traders settle in cash, this system can continue without issue. The problem arises when a meaningful number of contract holders demand physical delivery. When that happens, the market faces a stress test it may not be able to pass. We have already seen early warning signs in major trading hubs around the world. Reports from the London silver market have pointed to growing shortages and delivery delays. Some buyers have been forced to wait weeks or months longer than expected to receive metal. Similar tightness has been observed in Chinese markets, where physical supply has struggled to keep up with demand. These are not isolated incidents, but signals of a system under pressure. When paper markets collide with physical reality, prices can move very fast and very violently. This is why traditional price models often fail during commodity squeezes. History shows that when leverage unwinds, moves can be sudden and extreme. This is one reason large institutions prefer to quietly accumulate physical silver instead of relying on paper claims. Physical metal removes counterparty risk and cannot be created with a keystroke. Now let's talk about the role of major banks, because this is where things get uncomfortable. JP Morgan has publicly warned that silver prices could fall back toward $50 per ounce in 2026. They cite concerns about speculative excess and slowing demand. But actions tell a very different story than their public statements. This is the same bank that was fined $920 million for manipulating the silver market. The penalty was issued by the Department of Justice, the CFTC, and the SEC. The charge was spoofing, which involves placing fake orders to influence prices. For nearly a decade, traders pushed silver prices lower while accumulating physical metal. This history matters because behavior patterns tend to repeat in financial markets. When a bank with this track record warns of falling prices while hoarding metal, investors should be cautious. It raises the question of whether fear is being used as a tool to shake out retail investors. Lower prices make it easier for large players to accumulate more metal. This strategy has worked before, and there's no reason to believe it has stopped. Another critical factor is how fragile confidence in the paper market really is. Most investors assume they can always convert paper contracts into real metal, but that assumption only holds when demand for delivery remains low. If even a small percentage of participants request physical settlement, the system could seize up. This is why physical shortages matter so much more than paper price movements. When real-world supply runs out, price discovery changes completely. We've seen similar dynamics play out in other commodities throughout history. Nickel, oil, and even agricultural products have experienced sudden price explosions when supply was constrained. Silver's unique combination of industrial demand and financial speculation makes it especially vulnerable. Now let's shift focus back to the individual investor, because this is where strategy matters most. Many people believe that if they didn't buy silver at lower prices, the opportunity is gone. This mindset ignores how long-term bull markets actually unfold. Early gains attract attention, But the largest moves often come later as fundamentals tighten. Silver's supply deficit has not been resolved. Industrial demand continues to grow, physical inventories are shrinking. These are not conditions that support a long-term collapse in prices. Even if prices pull back in the short term, the broader trend remains intact. This is exactly how asymmetric opportunities are created. The downside is limited by real-world costs and scarcity. The upside is driven by demand that cannot be easily reduced. This is the kind of setup Warren Buffett looks for, even if he doesn't announce it publicly. He focuses on probability, not prediction. He understands that you don't need to time the exact bottom to succeed. You need to be positioned before the full story becomes obvious. Now let's talk about how everyday investors can think about exposure without taking unnecessary risks. There are several ways to participate in the silver market, each with different advantages. Physical silver offers direct ownership and removes counterparty risk. Coins and bars provide peace of mind, especially during times of financial stress. However, physical metal requires secure storage and may involve premiums. Silver mining stocks offer leveraged exposure to rising prices. When silver rises 10%, quality miners can rise much more. But mining stocks also come with operational and geopolitical risks. Silver exchange-traded funds offer convenience and liquidity. They allow investors to gain exposure without dealing with storage. However, ETFs still involve reliance on financial intermediaries. There is no one-size-fits-all approach. The right choice depends on personal goals, time horizon, and risk tolerance. What matters most is understanding what you own and why you own it. Blind speculation is dangerous, but informed positioning is powerful. Looking at the bigger picture, the opportunity in silver today isn't just about price movements, it's about structural shifts in the global economy that few investors fully grasp. We're witnessing a perfect storm of tight supply, soaring industrial demand, strategic accumulation by governments, and a financial system that may not be able to deliver metal quickly if stress arises. This combination of factors doesn't appear often, and when it does, history shows it can create generational wealth for those who are prepared and patient. Warren Buffett didn't get wealthy by following the crowd or chasing headlines. He looked for imbalance, scarcity, and asymmetric risk versus reward. Today, silver offers exactly that kind of opportunity, even though the mainstream media continues to treat it as a minor or speculative story. For individual investors, understanding the fundamentals is key. The price action we've seen in 2025 and early 2026 is just the tip of the iceberg compared to the forces building beneath the surface. Industrial demand from solar panels, electric vehicles, 5G infrastructure, and AI data centers is structural, not cyclical. This means it will continue to grow year after year, even if prices fluctuate in the short term. Central banks and sovereign wealth funds are quietly buying silver for strategic purposes, signaling that this metal is more than a commodity. It's a critical asset for the future. Meanwhile, large financial institutions are sending mixed messages to the public, warning of falling prices while quietly accumulating significant quantities of metal. These contradictions should raise red flags for everyday investors because it's often at moments of public doubt that the biggest moves are being set up behind the scenes. Volatility may scare some people, but for those who understand the long-term fundamentals, it creates incredible entry points. Corrections are natural in any bull market, and they often mark the moments when smart investors can position themselves most advantageously. The silver market today offers multiple paths for participation, each suited to different risk tolerances and investment goals. Physical silver gives you direct control, security, and removes reliance on third parties. Mining stocks offer leveraged exposure, allowing gains to outpace metal price increases, though they carry operational and market risk. ETFs provide convenience and liquidity, but they do not eliminate all risk. Whatever path you choose, doing research, thinking long-term, and ignoring fear-based headlines is critical. If you've been waiting for the perfect time to enter the silver market, this could be it, because the underlying supply-demand dynamics are unlikely to shift quickly. Even if prices retreat temporarily, industrial demand and physical scarcity will continue to push the market higher over time. This is not speculation based on hype. It's grounded in real-world factors that have been building for years and are now reaching a tipping point. History shows that the smartest investors make their moves when others are fearful, not when excitement is at its peak. Warren Buffett's silver play in 1997 is a perfect example of this principle in action. He acted when others laughed and ignored the opportunity, and the result was extraordinary returns over time. Today, the signs are repeating, but with even greater intensity and urgency. The supply deficit is larger, industrial demand is stronger, and geopolitical factors are adding a layer of safe haven buying pressure. Ignoring these dynamics entirely could mean missing one of the most compelling investment setups of the decade. Even small, measured positions in silver today could yield significant gains if the market continues along the path set by structural fundamentals. It's not about betting everything at once. It's about thoughtful positioning, patience, and awareness of both risks and opportunities. As supply shortages tighten and industrial demand accelerates, those who wait too long may find the entry point much higher than it is today. Silver is not just a commodity. It is becoming an essential cornerstone of the modern economy. From clean energy to advanced technology to strategic government reserves, silver plays a role that few other metals can match. This combination of scarcity, strategic importance, and rising demand creates a rare investment environment. Volatility, short-term pullbacks, and market noise should not distract investors from the broader trend. History favors those who remain disciplined and focused on fundamentals rather than emotions. Long-term investors who understand these dynamics are likely to see rewards far beyond what casual market watchers expect. Even if prices fluctuate in the short term, the underlying drivers point to higher levels over the coming years. The potential upside, combined with limited downside risk in a structured portfolio, creates a compelling asymmetric opportunity. Remember, Warren Buffett didn't get rich by chasing the hype. He got rich by identifying situations where potential rewards far outweighed potential losses. Silver today offers exactly that type of setup. It is scarce, essential, and undervalued relative to its long-term demand potential. The global market, including industrial users, governments, and strategic investors, is all quietly converging on the same conclusion. This makes silver one of the few opportunities where you can invest with both structural demand and potential upside working in your favor. Even if the mainstream media tries to create fear or confusion, the fundamental story doesn't change. The supply-demand imbalance, growing industrial need, and accumulation by smart money remain intact. For investors willing to learn, act strategically, and think long-term, this may be the moment to position themselves. Ignoring silver entirely could mean missing a generational opportunity that may not come around again for decades. The 380% potential returns I mentioned earlier are not fantasy. They are grounded in realistic scenarios based on current market dynamics and expected growth and demand. Industrial trends, government accumulation, and supply constraints all point to higher silver prices in the coming years. Even partial realization of these trends could produce extraordinary gains for investors who act wisely today. Now is the time to educate yourself, explore different avenues for exposure, and decide how you want to participate in this unique market. The key is preparation, patience, and discipline, just as Buffett demonstrated decades ago. This is why Alex Carter Reports exists, to break down complex markets in ways that everyone can understand, showing how smart money moves while the public is distracted. Silver is a story of scarcity, strategy, and opportunity, and those who understand it early have a chance to benefit enormously. Whether you choose physical metal, mining stocks, or ETFs, the most important factor is knowledge and timing relative to structural market shifts. For those willing to act now, history suggests that disciplined positioning could pay off handsomely in the years ahead. Don't let fear or confusion prevent you from seeing the big picture. Volatility is part of the game, but fundamentals always win over time. Silver is poised to remain one of the most compelling investments for the foreseeable future. As clean energy, technology, and strategic demand grow, the pressures on supply will only intensify. The smart money is quietly moving, positioning for long-term gains while headlines focus on short-term noise. By understanding this story, you can make informed decisions rather than reacting emotionally to market swings. The opportunity to benefit from this setup exists now, and the window may close faster than most people expect. Those who position themselves wisely could see rewards that far exceed what many think is possible. So take the time to research, understand, and act strategically. The silver market of 2026 is a unique convergence of scarcity, industrial importance, and strategic accumulation. Ignore it at your own risk, because the moves being made behind the scenes are not temporary. They are setting up for a generational trend. Warren Buffett's historic silver investment wasn't luck, and neither is the current setup. The fundamentals are real, the forces are structural, and the potential rewards are substantial. This is why positioning thoughtfully today could make a dramatic difference for your long-term wealth. If you found this breakdown useful, share it with someone who needs to understand what's really happening in silver. The more people who understand the market, the harder it becomes for institutions to manipulate it against everyday investors. So stay smart, stay informed, and remember, the best investments are often the ones everyone else is too afraid to make. Thanks for watching Alex Carter Reports, where we explore the moves the ultra-wealthy make and the opportunities they leave behind for those who pay attention. Hit the subscribe button, turn on notifications, and get ready for future deep dives into the silver market and the company's position to benefit the most as this trend unfolds. Stay focused, be patient, and remember that understanding the story behind the numbers is what separates smart investors from the rest. The window of opportunity is here, but it may not stay open forever, and those who see it clearly now have a chance few others will.